Today, we're moving forward in our Get Into Business 101 series for the summer of 2024. Today, we're talking about financing and due diligence. So, after you've got that offer accepted from the seller, how are you going to get the money together? How are you going to go through due diligence? How are you going to get it all done? We'll be back in just a moment. I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win. Welcome back. So this summer, I'm recording this special series, uh, all about buying, starting, getting into business, right? Because I get so many emails and inquiries from people who say, "Dave, I just need to get into business. Like, what should I do?" This series is for you. It's all celebrating the new book I have coming out Labor Day 2024, Buying versus Starting a Small Business: A Guide to Keep You from Going Broke. And let me tell you, I got the proof edition. The second proof is on the way. I just got the audio files from my sound engineer. He made my voice sound silky and smooth and deep. And it's as though I were talking about monster trucks coming this weekend to the local arena, let me tell you. So, if you're interested, you can head over to Amazon. You can pre order it on Kindle. On Labor Day, it will be available in paperback, as well as the Audible book will be available Labor Day weekend. People who are on my email list may have already heard a way of getting this book now. So if you're not on the email list, you may want to sign up over at davidcbarnettlist.com. And it's a great place to sign up because you just check off your areas of interest. I do send out an email every day, but only if it pertains to the area of interest that you've indicated. And I've got the QR code there on the screen. So if you're watching on YouTube or whatever, you can scan that with your phone and sign up on the email list. So today, what are we talking about? We're talking about due diligence and financing. And this is a huge area where I get questions from people all the time. In fact, I just completed a brand new module in my Business Buyer Advantage online training this earlier this year, all about due diligence. It's like, uh, well, if you include the audio content, it's like another 4 or 5 hours of content in Business Buyer Advantage just about due diligence. It's a bonus module called bonus module due diligence, right? So um, there's basically a bunch of different places that you need to investigate when you're buying a business. And I'm going to talk about that today. And then I'm also going to talk about getting the money together. So we're going to start with financing. Okay. So if you've got an offer on the table that says you're buying a business from someone, you presumably have to give them some sort of consideration for the business under the assumption that we're talking about a good, profitable business that has some value to it. There's a whole world of exceptions when we're talking about, problematic businesses, ones that don't make money. Maybe they're not actually an asset; they're more of a liability that someone would love to foist on you for very little money. But we're talking about profitable businesses today. So you make a deal, you're going to have to come up with some money to pay for it. And yes, there could very well be some seller financing that is part of the package. The traditional format for buying a business is that you put in some money of your own, you borrow some money from a bank, and the seller finance is part of the deal. And then the proportion of those different sources of money is going to vary greatly depending on, what the business is, what's in the business, where you are in the world, etc. Now, I meet a lot of people who are listening to stuff online about something called a search fund. Now, what is a search fund? A search fund is this concept. It's a search fund is a entity created by someone who decides, and this traditionally comes out of the sort of Ivy League MBA space. So an MBA person who might traditionally have had a career path of going to big corporate decides instead, I'm going to buy a business. And what I'm going to do is I'm going to get some wealthy people to put some money into a pot, and they're going to pay me to look for a business for like a 2-year period. And then when I find a great business, they're going to put up the equity money and I'm going to run the business and we're going to share the equity. Okay. So that's what a traditional search fund is. And this concept comes out of, I think the 1970s was the first time this was done. And so what has been happening though is as this whole silver tsunami and entrepreneurship through acquisition thing has grown online in social media, there have been more and more people who've been getting into this. And so in the search fund sort of online community, there's now a lot of talk of what they call self-funded search, which is just people trying to buy a business. Okay. So don't get all caught up in the nomenclature or the terms or the conversation. A self-funded searcher is just a person looking to buy a business. And so they have that in common with a lot of the people that are watching this channel, right? And so the one sort of degree of separation might be their educational background, maybe, differentiating a self-funded searcher from dude trying to buy a business. But in that world, because the original search fund model involved this equity investment from wealthy investors, in the self-funded search, there's this huge conversation going on still about the degree of involvement from equity investors. So let's talk about that. Let's talk about the reality of that because I meet people today who've been listening to some of this content or reading some of these articles online, and they say, Dave, I don't have a lot of money, but I'm going to get investors. And this is how I'm going to raise my equity. So, conversations with equity investors is part of the financing plan, right? It's equity investment versus debt investment. Debt's what we get from a bank, for example, or from the seller. If there's a seller note, that's also a form of debt. Equity is what we get from some kind of partner, can take various formats. It could be preferred shares in some examples. It could be that they have common stock or membership in an LLC with you, but there's some language in the operating agreement that gives them a preferred rate of return and the return of their capital before you get to take anything out of the business, for example, right? So all kinds of variations on this. And when it comes to doing these equity kinds of investments, really, the sky's the limit as far as what people negotiate. And all that really has to happen is if there's a bank involved, the bank has to approve of whatever the arrangement is between the investors, right? So this can sound very appealing for a lot of people because they think, wow, there's these rich people out there who want to invest in these small businesses. And if I find a great deal, I can gather some of these investors together to raise money. And then that can be my down payment and then I can end up owning this business, right? So I did a little bit of digging and research because there are people who spend time in this market actually doing research. So there's a group called the Search Investment Group, and let me show you this on my screen. So this is from their 2023 self-funded search study. So they went and they surveyed people who had done deals that were self-funded. So again, these are people who did not get investors together to earn money from their searching activity, but they managed to do a deal. Okay. And so of this sample, 30% of them bought businesses with an EBITDA under $500,000 a year. So I want to point that out because traditionally in the world of search funds, they're typically looking at what I would describe more as middle market or lower middle market businesses, where they're looking at like million, 1.5, 2 million of EBITDA. And the reason for that is because you need that higher level of cash flow in order to shoulder the debt burden of a bank loan plus some kind of preferred return to these equity investors before you, and then often there needs to be a plan to kind of like pay out the capital of the investors um, in some kind of reasonable time frame. So they typically go for larger businesses, but 30% of the people that were in this survey did acquire what I would describe as a main street business. And here's where the equity came from. And these numbers do not add up to 100% because many of the deals, of course, had equity from more than one source, right? So the first one I want to point out to you, the biggest one right there, 78% of deals were done with equity coming from the personal savings, assets, or net worth of the entrepreneur that did the deal, right? And so this kind of reaffirms a huge chunk of my content where I've been telling you, if you want to buy a business, live below your means and save up your money. Because 78% of the people that did these deals actually had to open their own wallet to put in money of their own to get the deal done. And then there are outside investors. There's four different categories that they chose or isolated here in the survey. So 42% of outside investors were friends and family, right? So it's like people that the entrepreneur knew personally, that they were connected with personally, right? So I sometimes get the question, how do I find investors? Well, you go to Thanksgiving dinner, apparently, right? And so th- this is where 42% of the investors came from, people that you know. Okay. The another 40% of these deals were funded by outside investors who were high net worth individuals. Okay. 17% were family offices. A family office is like a private investment firm owned by a family. So think about, a big name, like the people behind Heinz ketchup, right? Like the wealthy family from way back when, like they've got a lot of money, so they have their own sort of private investment company that's called a family office. So 17% of these deals had money from a family office investment source, and then 14% from private equity or other kinds of institutional financing organizations. So really minority. So, and the reason why I want to point this out is that a lot of the content online that talks about raising capital for doing deals, they talk about family offices and, private equity groups and high net worth individuals. And most of the time, they are not part of the solution. Most of the time, it's you, your own money, and the people that you know, your friends and family. So, again, this is why I have often said that if you intend to buy a business and you're a little bit short on cash, you need to find people that are going to participate with you. And the places where you find these people are around you in the community you exist in. So they're your family, your friends, your extended network of people that you are connected to. And if you find that those people that you happen to be connected to are a little short on cash, then you have to sit back and take a moment to consider, hey, maybe if I'm trying to level up my life, maybe I should be leveling up my friend group. Maybe I should be spending time with people who are a little bit further down this road than I am. And there's a lot of different ways that you can do that. One of my favorite that I like to recommend to people all the time would be things like service clubs. So, you join the Rotary Club, the Kiwanis Club, whatever. You can do a tour of the service clubs in your community. They're always looking for new members, and you can go find out who are in these different clubs. And what you will find is that there is usually, depending on the size of the market, a couple of clubs that skew heavily towards small business owners, accountants, professionals, insurance salesmen, like those kinds of people. And that's the club you want to be in, because not only are there business owners there who are likely going to have higher incomes and net worths, but there are also going to be people in there who are highly connected to other high net worth people, right? And so those are the kinds of connections you want to have. Because when you decide, I'm going to go do a deal, you already likely are going to need to have your investors within your network of people that you know. So there was a question just the other day, actually posted on searchfunder.com, where somebody asked, what, should I be doing with the investors that I find before I actually have the deal? And it's a big question, like what level of engagement should I have with these people? And I would argue that, if you see people in your extended network that you think are likely going to be investors in your deal, you should just be looking for ways to spend time with them so that they can get to know who you are as a person. Because looking at the deal obviously is going to be part of their decision to make an investment in your opportunity. But a big part of whether or not they're going to do the deal is whether they think that you're a capable and trustworthy person. And most people can only really determine that about someone else through spending time with them, right? So, we do business with people we know, like, and trust. Uh, if you are going to write a significant check and make an investment in someone's deal, you certainly have to know, like, and trust them. So just think about it from the other side's point of view. Be a little bit empathetic towards who your investors might be, and know that they're going to have to know you. They're going to have to trust you and think that you're capable. And how are you going to get from where you are today to that point and stay in that sort of space with them until you come calling saying, "Hey, guess what? I just signed an LOI or I have an accepted offer. I'm getting into due diligence and now we need to do this." So, I've been talking about equity investors. Now let's talk about lenders, right? Because again, you are not going to get a term sheet from a bank unless you have a deal for them to look at. However, that doesn't bar you from creating a relationship with bankers. In fact, you should have a short list of lenders that you feel that are going to be appropriate for any deal that you might do, and you should make some effort to connect with those people. So, bankers, as I've said before, are salespeople. Their job is to create assets for the bank. An asset is a loan, right? Because from the bank's point of view, they put money into a business deal, for example, and then they earn interest on that. That's an asset to them, right? So the banker's job is to create assets for the bank. Having a relationship with you, because you're trying to get a deal done, is part of their deal pipeline, right? So find out who the small business advisors are, or for some of you in the United States, if you go to a local community bank, you might actually get to talk to someone with the title of vice president, um, who might be in charge of small business lending or something. So get to know who they are, talk with them about your goals, what you're trying to do, what kind of deal you're trying to do. Ask them, do you do small business loans, SBA loans, for example? And then what are the other types of deals that you do with small businesses? If I don't do an SBA loan, do you fund equipment acquisition? Do you fund inventory? Do you do lines of credit for receivables? Like, what are the options that I might be able to come to you for? And work on that relationship so that when you have a deal, you have this instant shortcut to a person that can help you talk through the deal. Because again, a lot of people will approach me and it's almost like they're trying to game the banker. Like they're trying to say, like, what do I say? What do I do? How do I, present this so that they'll give me the loan? And that's really not the way to approach it. The way to approach it is to look at the banker for what they are, someone trying to make a loan, right? So they're trying to make a loan. So you should be talking with them about what they need to do their job, right? So you're looking at a deal, you're going to make an offer on a deal, and you're about to submit an LOI. It'd be great to have a relationship with a banker where you can call them before you submit it and say, "Here's the broad strokes of the deal. This is what I'm thinking about submitting. Does that sound like it's something that you'd be able to work with?" And, this happens all the time. The banker who's got experience, of course, from having funded many people's acquisitions could say to you, "Well, actually, it would work better if you did this." And they could like suggest some things to you that would make the deal more financeable and may have zero to like little to no impact at all on the seller or yourself, right? They could make some suggestions about how you change things. So this is why a banker is part of your team. Go back and see, what was it? Episode number 2 or 3 was, building your team. Yeah, number 3. So listen, if you haven't been watching all the episodes in this summer's series, you need to. Okay. So the seller financing. So I said that most deals involve some degree of seller financing. Don't open with that when you're talking with sellers. As I mentioned last week, um, you want to look at the business, make sure you like it, and then lay the foundation for asking for seller financing and then put it in your offer. And maybe you make more than one offer at the same time, which is a strategy I often recommend. And then have some offers with more seller financing, some offers with less seller financing, to let them decide how to what degree they want to participate and make it something that is worth their while. So deals with greater amounts of seller financing should be at higher prices or have other features to them that make it more lucrative for the seller, because if they're going to remove part of the hurdle of you getting financing or raising capital or whatever, that's worth something to you. Okay. So that's the financing part, arranging the financing part. Let's talk about the due diligence part. So we've got 3 different categories of due diligence. And then there's another part of the due diligence process which involves attorneys or lawyers. Okay. So let's talk about that part first. The legal paperwork, actually setting up your entity that's going to do the acquisition, and doing the contracts for the purchase and all that kind of stuff. So that part of it should actually not happen right away. It should happen a little bit later. You should be doing part of your due diligence to make sure that the deal looks like it was presented to you, that the business seems to be good and everything, before you start to get down the road of creating the purchase and sale agreement and all that kind of stuff. Because if you get 2 weeks into due diligence and realize there's all kinds of problems that were not revealed to you before, then you can withdraw from the due diligence process before you've begun to incur the legal expenses of actually having the final contracts done up. Okay. That's always the way I've done this. In fact, you should be thinking about this whole thing in terms of critical path. So if you don't know what that is, look it up, do a quick Google search. But if you imagine getting from A to B, these are little projects or things that have to happen along the path from A to B. And some of these different projects and things can be done concurrently. Back when I first did management science in the 1990s, we used to draw these with paper with arrows and pencils and stuff, and we would have these different critical paths or pathways of things that had to be done. And the longest one was considered the critical one because if that one got delayed, it would delay the whole project. And so you've got the financial legal paperwork for doing the deal, but then there's also three different aspects to due diligence. There's the financial due diligence, the business due diligence, and the legal due diligence. Okay. So what are these three different categories of due diligence? Well, the financial due diligence is the one that everybody focuses on, which is actually making sure that the financial statements or numbers that were provided to you before your offer are in fact true. And a lot of people talk about something called a quality of earnings. So, a quality of earnings report is basically hiring some professionals to come in and sort of rebuild the financial statements of the business. And it can be very expensive. It's usually a five-figure project. And so the issue is that if you're doing a smaller deal, like if you're buying one of these Main Street businesses that we talk about, it can be a big pill to swallow to be talking about a $25,000 Q of E bill to buy a $700,000 business, right? And so what you need to assess is you need to assess what is the level of financial due diligence that actually makes sense for the size of business that I'm buying. So, for example, if you're buying a company that does flood and fire restoration, right? This business has no till. They're not accepting cash from anyone. Everybody who hires them, there's a lot of paperwork with every ticket, every job they work on. And a lot of these jobs are paid by insurance companies and they're all being paid by check or ACH or whatever, right? So it's not that big a job. Over the run of a year, maybe they did a couple hundred jobs. It's not that huge of an effort to actually go and look at every project and then look at, the estimation, look at the billing, and then match that to the payment, right? And then you add up all the payments and see if that matches what they put on their tax return for the revenue for the year. Like it's not hard. It's just work, right? And so for a lot of people that are buying a smaller business, what they really need is they need an experienced CPA who is familiar with how small business books can be messed up so they can recognize things, they can recognize common problems that sort of DIY bookkeepers might have because a lot of these small businesses don't have professional bookkeeping. So you want a CPA with experience, obviously someone who has experience with helping people do deals, and not that you necessarily want them to do all the due diligence, you want them to guide you through it. So they can very easily say to you, take all the bank statements for 2023 and add up all the deposits. You can do that, right? Well, that's a very basic kind of part of this financial due diligence. So you go in, you figure things out, you add things up, you get advice from them. They will help match things, bank statements versus the QuickBooks files and stuff like that. And if you find something that's a problem, all it does is it opens a question. You go back to the seller and you say like, how is this? Why was this done, etc. And then you kind of build a picture of what's really going on in the business if there's much of a difference from what was presented to you. And then you make a decision. Do I use this as a means to renegotiate part of the deal or do I just retreat from it? Okay, so that's financial due diligence. Business due diligence is actually understanding what the heck goes on in the business, right? So this is understanding the business model, understanding where does the work come from, are there key relationships that are important, etc. So if you're talking about a paint store, right? As an outsider from the paint industry, you might say, well, people walk in when they want to paint their bedroom. It's just a retail store. But what I know about the paint industry is that that retail storefront could be doing 75% of its volume with local contractors, right? So the Monday to Friday 9 to 5 business is contractors, or sorry, the Monday to Friday sort of 6:30 a.m. to 9 a.m. business, like before the retail customers even show up, are these contractors who are showing up, who are painting whole houses or apartment buildings or offices and things like that, right? And so how are those relationships managed? What are they doing to keep those people happy, et cetera? So that would be an example of business due diligence, understanding, the how things work in the business, how the trade works, et cetera. Um, the legal due diligence is again something where you're going to need your attorney or lawyer to be a part of. And this is different from the deal making legal work. So, in the legal due diligence, what the attorney is doing is they're looking for outstanding legal issues in the business that might have some kind of impact on you if you become the new owner of the business. But they're also looking at sort of the legal frameworks of things that are in the business. So, for example, if you've ever signed a contract, I had a home energy audit done at my house, because there's some government grants available for different upgrades, right? And so when the energy auditor came to my house, he's like, I need you to sign this because it includes all kinds of stuff about privacy legislation that will let me share information with the power utility, or whatever, right? So I just signed it. Well, if you were going to buy that energy auditing firm, you would actually want a lawyer to read that agreement. Like, is the agreement in use today actually doing what they believe it's doing? Is it actually written correctly? Does it comply with laws? Is it actually asking for one thing while at the same time perhaps creating a conflict in another way? So if the business at hand uses any kind of paperwork or anything like that, you want a lawyer to review that stuff just to give input or see if it can be simplified or what have you, or if there's something better, or if there's a problem with it. Um, if there are contracts in the business, if some customers have signed long-term contracts, you may want some of those contracts reviewed, right? The lawyer may be able to give you an opinion about whether they are even assignable, if you bought the business as an asset sale, would those contracts necessarily automatically come over to you? Or would it create this hazard where some of these things might go up for rebid? So I've got a client who's in the janitorial business, and a lot of the businesses that he will buy, they might be doing things like cleaning the county courthouse. And so the contract with the county government actually says that if the business is sold, the county has the right to rebid or put the contract out to tender. So what would that mean? Well, it would mean that the contract, this part of this recurring revenue that you want to obtain would be put in jeopardy through you acquiring the business as an asset sale. But if you bought the shares of that janitorial business, the EIN number doesn't change. It's literally the same entity. From the county government's point of view, there's been no disruption in service. And so this is what he does is he buys the shares of these companies. So that's all part of the legal due diligence. Now, one of the questions, of course, because we're talking about buying versus starting a small business this summer, new book available Labor Day, Buying versus Starting a Small Business, a guide to keep you from going broke. Um, Part of this is about buying, right? So, one of the things that you can be thinking about when you're doing this due diligence process is what would this all look like if I was starting the business instead, right? Would I be doing anything differently? Is there any kind of legacy issues or um, um, vestiges of the old way things are done? Like, is there part of one of these business processes involving a fax machine or or something like that, right? And, would it be simpler, easier, faster, less costly to replicate this if I just started something instead? And the answer very well could be no, right? But that's what you want to be thinking about as you go along. You always want to have that startup as part of a potential opportunity. If your deal doesn't work out, what would it look like if I started instead? Now, you could very well be hampered by some kind of non-compete, or the NDA may say that you can't use information gathered in your due diligence to, compete with the business. That could very well be in there. I'm not telling you to do anything illegal. Just keep it in mind, because one of the questions that you always want to have on the top of your head is, am I getting swept up in buyer fever that I mentioned a couple weeks ago? Am I becoming emotionally attached here? Am I just way too enthusiastic because I think buying this business is going to be really easy compared to starting one? And, does it make sense for me to do this deal? That's always going to be at the back of your head. Does it make sense for me to do this deal? Because quite frankly, I would rather see you have your money in the bank and work a job you really hate versus getting into a bad deal or overpaying for a business that doesn't turn out to be as good as you thought it was going to be. Business is risky, and the vast majority of small businesses do not last forever. Um, yeah, so it's a risky asset class, and I don't want to sugarcoat that. And I think you know that. That's why you tune into this channel. Anyway, thanks everyone. It's been great to see you. If you're like new in this journey of getting into business, this entrepreneurship journey, check out the new book. If you are serious about buying a business, if you think that that's the right solution for you, then you should be heading over to businessbuyeradvantage.com. That's where you can learn all about my online training, my group coaching program, and the buyer insight analyses services that my company offers, where we will do an investigation into a business and really examine it and help you formulate some offers that make sense. And we help a lot of people with that, and so I'm really proud of the fact that we've helped a lot of people see things that were not as rosy as they might have believed, and that we've helped them to avoid some bad deals. And so with that, I'll say thank you very much, and we'll see you next time. And so, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally, and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.